Hello and welcome to Pro Trader Strategies Market Commentary for Wednesday, April the 12th. My name's Eric Wilkinson. Some of you may recognize me as the Wolfman from CNBC, Fox Business, or even the Wall Street Journal for my commentary on everything from economic to geopolitical and market analysis. Please keep in mind that everything that we talk about in these daily market commentaries is not a solicitation to buy or sell any of these securities or strategies. At the end of the day, we're here to teach you some different strategies that you can implement into your portfolios, but please do that in your own way. The reason why I can't give you a recommendation on a particular stock or strategy is because I don't know your risk parameters. I don't know what's in your portfolios, and therefore what I'm doing could be counterintuitive to what you are already doing. Having that out of the way, let's get this on. Not a whole lot of economic data. We did get across the pond in Great Britain, the unemployment rate came in at 4.7%, was expected to be right there at 4.7%. But claimant count, which is basically equivalent to the unemployment claims, basically came in at 25.5 thousand, was expected to be a pullback of 10.2 thousand. So quite a bit of drastic change there. More people seeking unemployment claims in a sense. And then average hourly earnings came in at 2.3%. Increase was expected to be a 2.1 increase. That's a little bit better than expected. Earlier on this morning, we had President Trump speaking. Not a whole lot coming out of that. But here in the United States, we also got importer prices came in as a decrease by 0.2%. It's supposed to be a decrease by 0.3%. So a little bit lower than expected there. And then here also we got the crude oil inventories was expected to be a drawdown of 0.7 million barrels or 700,000 barrels. Actually had a drawdown of 2.2 million barrels. So a bit larger drawdown than what was expected there, and no revisions to last month's number. Having said that, with that drawdown, of course, we have crude oil down. Makes absolutely no sense necessarily whatsoever, but crude oil, taking a bit of a breather. Right now, the way the chart is looking, it doesn't necessarily look like it is a topping pattern or anything. It actually almost considers leads one to believe that it's a continuation pattern if we were to settle right here or slightly higher. So getting very comfortable at this level of 53.05, becoming where the most volume has been spent. Starting to look like the time node is starting to increase there as well. That could have a tendency to make that pop a little bit higher, showing there's acceptance at these levels. So going forward, we're going to have to keep an eye on that to see if my target is still going to be feasible. On to gold. Gold's moving higher as the overall equities are coming back a little bit. Gold is going to be a safe haven for those. As you can see yesterday, gold just blasted off and stayed high despite the fact that the overall equities made a big rally at the end of the day. So people still throwing money at gold as a safe haven. We're also seeing volatility increase, which leads one to believe that people are getting a little bit nervous about the upside and starting to put on some protection, because a lot of times when the VIX is spiking, it is directly correlated to the premiums in the puts. So as people get nervous, they buy puts to cover their positions or hedge their positions, and that causes the VIX to overall increase. Then on to the bonds. They're unchanged right now, been teetering back and forth, positive to negative territory as the overall equities are coming off. Don't really see, even if we have a decent pullback, maybe a flight to quality, but bonds really are kind of stuck in the mud, if you will, because the Fed has already told everyone what they plan on doing for the foreseeable future, and that's increasing interest rates at a 25 basis point clip. The overall markets price that in. So if the markets price that in already, we can't really, if they start rallying, it's looking like the Fed is going to hold off on interest rate cuts or interest rate rises and or create a lower interest rate environment, which I don't really foresee happening. So bonds really can't react too much on an extended move to the upside, because that would increase or indicate a higher interest rate, or sorry, They can't increase too much to the upside because that would be a lower interest rate, I should say. Then on to the Dow Jones Industrial Average. They're down about 60 points, 70 points, I should say, on the day. But what I want to talk about is the 50-day moving average. Yesterday, we kind of pierced that for a minute, and it's not a big deal to pierce this line. It's really whether or not we settle above or below that line. We settled above that line, but below the 5-day moving average, which is still short-term bearish. If we get below that 50-day moving average, that's indication of a longer bearish move, or at least trending down. The bigger cross would be the 50 to the 200, but we have a long ways to go before that happens. So at least in the near term, still slightly bearish in sentiment. If we get that crossover, that increases the sentiment to the downside. Then on to the NASDAQ. NASDAQ's down about 25 points, not quite as low as yesterday's low, but still giving up a bit of ground to the downside. But again, anything between 53.22 and this, I'd say probably right around here, which is about 54.57, 54.60, let's call it, is going to be where there's a nice trend. It's still stuck in a sideways trend, if you will, going to be building out this node. Again, if we break below anything below 5,300, that's where we could easily see this market just slam down all the way to the value area high, in a sense. So just to keep that in mind, and that would be a pretty big correction, if you will. Then on to the E-mini S&Ps. Let me go to this one. E-mini S&Ps on a daily chart, off 10, 11 points, let's call it. But again, still stuck, as you can see, in this node here. And again, we need to get a little bit lower than that to really start slamming down to find this node here, which is very close to the value area high, very similar to what we saw in the NASDAQ. So still trending sideways for the most part in the E-mini S&Ps. But let's take a look at the 30-minute chart of the E-mini S&Ps on a 20-day expansion here. Overnight, as you can see, we were quite a bit higher right at midnight for the most part. Not a whole lot of data coming out across the pond, so I don't think that that's necessarily what caused this to start coming off, especially just with Great Britain's claims coming in a little bit higher than expected. But at the end of the day, tested that point of control for the time, and the overall markets just kind of started giving back, maybe a little bit of profit taking as the overnight was caught long, and coming into the day session they started looking to cover those. So overall market's pretty thin on volume, as you can see down here. Not a whole lot of volume overnight or into today, but just pretty much profit taking, stuck in a range. Good day to possibly trade as an inside day, because you basically want to buy when it tests these areas here, or even this one for sure. Get long on that move, and then just have a tick stop a few ticks below that, maybe even just below this area here. But anyway, just intraday thought on trades for scalping purposes, if you will. All right, on to the trades that I've done with Macy's. If you remember, I've been trying to get out of this April 28.5 puts for quite a while. Originally sold them for 50 cents. Bought them back yesterday for 21 cents. So I'm out of that trade for Macy's. Got a little bit better than 50% of my max profit on that, which is what I look for in a trade like that. Volatility is increasing ever so slightly as the broader market's coming down today. So, and we should really see this volatility increase all the way into the earnings. So, we could conceivably see it go about 7 percentage points higher. So keep that in mind, which is why you don't want to be selling premium necessarily around those earnings, because you could be directionally right, and that is going to hurt you on your directionality there. And then on to a trade that I did today. Basically, if you guys remember, I did Disney as the poor man's covered call. So this was part of that whole webinar series on poor man's covered call, how to use leverage in order to simulate a long stock position. So in this, originally what I had done was gone in and bought the January long duration calls in there, and then financed the extrinsic value by selling some March calls. So it's basically a covered call strategy synthetically built out. And the beauty in this, it also has an embedded put in there, so I limited my risk to the downside as well. So in that poor man's covered call, if you remember, I had on the March, rolled those out to the April, collected another 42 cents. Now that those April are getting ready to come off the board, I rolled those out to the May, and I'm still in the 115 calls, collected another 147 for that. So almost $2 credit collected for that. So I'm lowering my overall basis on this, increasing my probability of profit, because as this market goes higher, I've increased that spread width in a sense synthetically by collecting more and more credit, and I've limited more of my risk to the downside. Now theoretically, if I could do this throughout the entire year, I might be able to collect back the entire credit for or collect enough credits to pay for the entire debit I paid at the onset of this strategy, and then I'd have on Disney for free. So that's what I'm looking to try and do with this strategy. Disney's been kind of stuck in the mud, going sideways, as you can see, since I put this strategy on. So best case scenario would be to roll these up and out in time, which I thought about doing because I could have collected about 30 cents for that by rolling it up and out. But I decided I got a bit of a tweezer top. This is going to act as a pretty major resistance here, and my calls are just slightly above that. So if it goes up and pierces those 115 calls, I'd be quite happy, because I don't know that it would be necessarily sustainable. The other thing is we're coming into that earnings during this May, so if I get a bit of a pullback, I'll immediately be able to take advantage of some of that volatility crush going into that. I actually even thought about going and staying naked long these, but I decided I didn't want to take that risk and wanted to just put on another strategy and stay mechanical with that. That's about all I got for you guys today. Clearly, I am out of slides. So anyway, pull back the Disney just so you don't have to stare at my window. Friday's webinar is going to be on earnings. So we're going to continue this earnings series. We did the short call strategies. Now we're going to be doing the short put strategies to show you how to set this up to increase your probability of success with these earnings. And I'm going to go through a little bit more detail. So even if you saw the call one, I'm going to go into a little bit more detail, a couple of things that I may have left out or not explained as well during that short call one. So it's not necessarily the exact same rule, or it is pretty much the same rules for the most part, but I'm going to go into some more of the nuances as to how to figure out what your pricing is going to be after the earnings crush, so, or the volatility crush in those earnings binary events. All right, so go to protraderstrategies.com and sign up for that and the future ones that we have coming up with the Iron Condor, and further how to be mechanical on these strategies that may have gone against us. All right, so we're going to show you how to play around with these strategies and continue to be mechanical to try and become profitable on one that may have gone against the probabilities on us. All right, so protraderstrategies.com, sign up for that, and if you can't take that, take it easy.